Let me ask you something most financial advisors probably won't tell you. Right now, somewhere out there in the stock market, there is a highly profitable, completely debt-free company. It's generating massive cash and is trading at exactly half its actual value. It's cheap, and not because it's broken, but simply because the market is emotional, a bit irrational, and just looking the other way. Welcome to this explainer, where we're going to track down these hidden gems, what we like to call sleeping giants, using a really powerful approach known as the FTP method.
Okay, let's look at our agenda for today. We're going to cover what value investing actually is, then we'll break down the FTP framework, move into reading financial DNA, and wrap it all up with the 4 magic numbers.
Section 1. What is value investing?
Value investing is the simplest and most powerful investment philosophy ever discovered. It was developed by Benjamin Graham, the man who taught Warren Buffett everything he knows. And the core idea fits in one sentence. You buy something for less than it's actually worth.
In the stock market, this means finding a company where the stock price is significantly lower than the company's true fair value, what we call the intrinsic value. The gap between the price you pay and the intrinsic value, that's your margin of safety. The bigger the gap, the safer and more profitable your investment.
Here's an analogy. Imagine you're a property investor. You know a house is worth $500,000, but the owner is desperate to sell. They're asking $200,000. You buy it, not because it looks pretty, because you know what it's worth. That's value investing. Value investors do exactly this with stocks. They find companies the market has temporarily mispriced due to panic, bad news, or simple neglect, and they buy them at a discount. Then they wait for the market to wake up and reprice the stock correctly. That's how generational wealth is built.
Section 2. The FTP framework.
So, think of the FTP method like a 3-legged stool. If you knock out even one leg, the whole thing just falls over. First up, fundamental analysis. This is where you analyze a company's financial DNA so you know exactly what to buy. Second is technical analysis. You're reading the charts to figure out exactly when to buy. And third is personal analysis. This is all about human psychology, understanding why the crowd is wrong and why the stock is mispriced in the first place. You absolutely need all 3 of these layers working together to minimize your risk and maximize that profit.
Section 3. Reading financial DNA.
Before you put a single dime on the line, you've got to read a company's 3 main public statements. It's exactly like a doctor checking a patient's medical records. First, you've got the income statement. This tracks money in versus money out, and you're looking for consistent revenue growth and solid profitability. Next is the balance sheet, which checks assets against liabilities to make sure the company has real financial strength and low debt. And finally, the cash flow statement. This confirms the money is actually there in the bank, showing real positive operating cash flow. Clean records here mean you found yourself a healthy, robust business.
Section 4. The 4 magic numbers.
All right, let's dive right into our giant screen checklist. Our first magic number is return on equity, or ROE. This basically measures how efficiently management is taking your money and using it to generate profit. We want to see this metric consistently above 15% over a 5-year period. If they can pull that off, it proves this company is a reliable profit machine. It takes the equity you hand over and gives you an incredible return on it. It's honestly like unlocking a secret formula for compounding your wealth. Metric number 2 is the price to earnings, or PE ratio. Now, for deep value, we're looking for a PE less than 5. To put that into perspective, it literally means you're only paying $4 or $5 today for every $1 of annual earnings the company generates. It is the absolute ultimate test for cheapness.
Think about it like this. Imagine 2 fruit stalls, right? Both are selling the exact same type of apple. Why on earth would you go to stall A and pay $25 for an apple when the guy at stall B is selling that identical apple for $4 just because he happens to be retiring? You wouldn't. Well, the stock market is exactly the same. Low PE stocks are your stall B. Same great underlying assets, just priced perfectly for a smart shopper. Third on our checklist is the price-to-book ratio, or PTB. We want to see a PTB below 0.5. That means you're buying the company's underlying assets at a massive 50% discount. It's like buying $1,000 worth of real, tangible assets for just $500. And what's great is that this creates a natural, sturdy floor under your investment. Even if the business itself hits a rough patch, the physical assets are still worth double what you paid for them.
And our final magic number is a dividend yield greater than 5%. I love to think of this as getting paid to wait.
It acts just like rental income on a piece of real estate. You get a consistent paycheck while you're waiting for your undervalued stock to finally bounce back to its true price in the market. It's solid passive income and, frankly, a clear sign of a really strong cash-generating business.
So you've got the giant screen to track down these sleeping giants. But here is the critical final thought I want to leave you with today. Knowing what to buy is really only half the battle. Think about it. If you find a great, deeply undervalued company, but you buy it at the absolute wrong moment, you can still lose money in the short term. So how do you perfectly time the market's optimism to strike at the exact right second? Well, that is the exact question you'll need to answer next as you master the technical analysis leg of the FTP stool.